Snap shares sinking off just about 13% in extended trading following a disappointing guidance number from the company as they kick off some of the big tech earnings that we have this week. Wall Street expecting certainly a rough quarter. We want to bring in Keith Lerner, Truist Co-Chief Investment Officer. Keith, it's great to see you here. So with Snap disappointing on guidance on the heels of Microsoft offering lackluster guidance from that company as well. Your take on the earnings season so far, specifically what we've seen from tech?
Sure, and hey, great to be back with you, Shawna, for you and Dave. I think earnings season, that the numbers actually haven't been that great. Overall, you're seeing the beat rates or the margin of the beat rates relatively low. But what's more important from a stock market perspective, the market is shaking it off. And the question set becomes, why is that? I think you came into this year, you had a sell-off in December, a 6% sell-off. I think expectations were really low, and that's why the markets are reacting even favorable. Not aside from Snap, in general this season, we're seeing stocks act somewhat favorable. But thinking about tech, I mean, the big numbers that really matter are going to be out later this week. I mean, on Thursday, we have Apple, Amazon. I think we have Meta maybe tomorrow. So those are going to be the big heavyweights that are going to matter more for the market. Overall, our position on tech, we're still somewhat skeptical that that's leadership for the market this year. They are oversold. They are being up. But we just think they've had such huge outperformance over the past decade that they're unlikely to be leadership in the next cycle.
Yeah, Google's up about 11% this year. Meta's up 20%. Amazon's up 20%. Even Peloton up nearly 60%. Is this trend built to last?
It's interesting, Dave. Just more specifically, what you just talked about, these big numbers, I think they should be put in context because we did a study that we just published yesterday. And what we looked at is the bottom 50 stocks in the S&P were down an average of about 52% last year. Those same stocks, those same 50 stocks are up an average of over 20% this year. And what's also interesting when we look at the work is every single one of those bottom 50, every single stock is up. So what does that tell you? That tells us that there was a lot of tax loss selling, that these stocks were sold off hard at the end of the year. The calendar changes, the tax loss selling subsided, and there's been a kind of a mean reversion. And these stocks have bounced out. A lot of the ones you mentioned, another one like the ARK ETF, up 25% this year, but flat since December. So we think this is more of a mean reversion. But we don't think it's sustainable. We think it's kind of more of more reflective of an area that was just really beaten up. We just don't see that as more likely leadership, given we still think the economy is likely to weaken, and we're not going to have a lot of liquidity come in, which typically helps these type of stocks.
Well, Keith, do you think we're going to start seeing that reversal this earnings season? It certainly looks like that's what we're seeing with Snap here after hours.
Yeah, listen, what you're seeing on this earnings season is just more discriminate as far as you're getting hit 10%, but then you saw like today, GM reacted really well to earnings. You saw some of the industrials have really big days as well. So I think overall it's been mixed. I mean, we actually have a more favorable view going back to the industrials. Look at the defense sector today. That's on the cusp of a fresh absolute high and also acting well on a relative basis because they have some secular trends as far as defense spending, reshoring. So we'd rather stick with some of those areas where we think there's some unique aspects to this cycle, even though we still expect the economy to slow somewhat this year.
So when it comes to the big three, Apple, Amazon, Alphabet, if you were to put them together, what's the one question you want answered about all of them that'll give you a better direction?
Yeah. Well, I think the question for tech in general is, there was so much pull forward demand, right? And all the layoffs you're hearing from tech, I mean, that in context, it's nothing relative to how much they hired the last few years. So I guess the question is, where are we with that pull forward demand? What is the earnings growth outlook? Are they going to grow stronger than the overall market? Because the one reason you buy tech is you pay a premium for tech is they're growing faster than the overall market. Over the last year, that hasn't been the case. The earning trends, the earnings momentum has been much weaker. So I really think that's it. Have we kind of moved past that soft spot and start to see some reacceleration? And then lastly, also, businesses are cutting back on expenses. A lot of these big companies are, a lot of companies are looking at these bigger technology companies and just taking a little bit back from them. So I'd be curious to see, what they're seeing from the corporate spend as well.
Well, Keith, what are you expecting to see from Powell tomorrow? Because we know the rising rate environment obviously will be challenging here for a lot of those larger cap tech companies. Lots of questions about what exactly has been priced into the market up until this point. What do you think?
So I don't have much qualms with the way the market's pricing things right now, like another quarter point hike tomorrow and then another quarter point maybe in March. But I think what he really needs to discuss and what I'll be looking for is, how long, are we going to keep rates higher? Because right now there's a disconnect between the market starting to anticipate some significant cuts by the end of the year. And Powell has been saying that, that they're going to keep them higher for longer. And that's our call as well, because we think there's scar tissue of this inflation of last year. So I think he's going to talk about that. I mean, financial conditions, which they've talked about a lot, have eased quite a bit. So I don't expect him to talk, overly, soft about as far as things. I think he'll be a little bit still somewhat hawkish and maybe change the tone about the length of before they actually go ahead and cut rates.
But as for where Truist is, you see a 25, and a hold until 24.
Yeah, well, I think actually our baseline is by the end of the year we'll see likely one cut. The market is pricing more of that, and again, we think the response function from the Fed isn't going to be as quick as it has historically, where they would have been cutting quicker and deeper, because this is the first time in over a decade they've had to deal with inflation. So we think that scar tissue will have them leaving rates higher for longer. And I think he'll have this opportunity to reset that with the overall market tomorrow.
All right, Keith Lerner, Truist, always a pleasure, sir. Thank you.